Hello, my name is Mark Mayfield, and welcome back to another PFA update. As we near the end of Q3, now's a good time to reflect on the markets and review financial plans for the rest of the year. August began with one of the sharpest declines we've seen over the last 2 years, but since then we've seen the major indices rebound from those lows. The Federal Reserve is expected to cut interest rates here later this month in September, and so that expectation has caused rates to stabilize, and inflation remains on a downward trajectory. This chart here shows the annual returns for the S&P 500 illustrated in the blue bars, and the Bloomberg U.S. Aggregate Bond Index, the gold bars. More focused, kind of looking at returns year to date. Major indices have shown significant gains throughout the course of the year. The S&P 500 year to date at this time is up 17%, and this is all despite quite a bit of market volatility. This year we've had two periods of sustained pullbacks. We had one in April, and then here more recently at the beginning of August, where we had major indices down about 8% in 1 day of trading. But as I alluded to earlier, the markets have rebounded from those lows. We haven't quite recouped all the losses, but we're a fraction of a percent off from those highs. If you look at the bond index is positive year to date. They struggled much of the year just with higher rates, but expectations of rate cuts coming later this month in September have certainly helped boost those returns as of late. This chart here takes a look at the federal funds rate. The solid line is kind of what the rates have been historically through different periods of times. The dotted line at the end is kind of the projection that the feds have released at one of their most recent meetings of kind of their path for cutting rates over the next couple of years. So again, a rate cut is expected here in September, 0.25%, and it looks like there may be more cuts coming in 2025, 2026, and ending in maybe 27. A lot of this is due. The rate cuts are coming on the heels of inflation has began to ease while it's still higher than where it was pre-pandemic. We have started to see that to come down, and then recent job numbers have shown signs of softening as the unemployment rate most recently rose to 4.3%. So a lot of the market swings this year have been a result of shifting expectations around what the Fed was going to do with interest rates. Towards the end of last year, first part of this year, investors were very optimistic that the Fed would potentially cut rates earlier in 2024 and maybe have multiple rate cuts in the year. And then we kind of shifted to late Q1, Q2, and inflation numbers were coming in higher than expected. And so then you kind of had the same, the expectation switched from rate cuts to potentially no rate cuts at all. And then now you've kind of seen the expectation come back as, okay, we're going to get a rate cut. So that's been part of the reason we've seen some volatility here in this year. Markets can get ahead of themselves, so it's important not to get swept up in the latest market moves and just stay true to your diversification and true to your investment strategy. Lastly, we're going to take a look at the Treasury yield curve. This chart shows the curve over 3 points in time. So we have the latest market day, the end of the previous quarter, and then the end of the previous year. As you can see in the chart, the yield curve is no longer inverted as market-based interest rates adjust to potential rate cuts, and yields are moving lower on the short end. Historically, when the yield curve becomes inverted, that traditionally is preceding some sort of recession. So recession may be on the horizon. However, this time could be different because short-term yields, higher short-term yields resulted from inflation shocks rather than the Fed over-tightening. So I hope you found this video and these insights helpful, and we will catch you next month. Thanks.